Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I offer in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn & Associates with your weekend update for the financial markets on this Friday, the end of a quarter, the end of a month, the 31st, 2016. Well, as you can see, down today in the stock, in the Dow and the S&P, while the NASDAQ churned up another gain, just record after record there. But overall, the markets are still pretty darn good. If we step back and look at a monthly chart on the Dow, you can see how the market's gone from 17,418 to 20,817. And we do have a correction finally setting in. And for the month, the market is down 203 points. So we've gotten a bit of a break there. On a weekly basis, the market was up 29 points. But as you can see, it's still backed off on, 5 weeks now, where the market has given us a bit of a correction. The pattern on the weekly chart is a bit bearish because you've got lower highs and lower lows. That's the indication of a bear market until you get over 21,028. But countering all this and making it just a correction is the fact that the market is staying over the 18-week moving average of closes and the 100. So correction, yes. A real trend, no. That's what that chart is saying. In terms of Bollinger Bands, when you made your run about 5 weeks ago towards that high, since then you've corrected. It wouldn't be bad to see the market hit that 18-week moving average of closes. And I say that because the momentum has slipped down. It's no longer embedded. And typically when you get these type of actions that pull back, it's not uncommon for the market to dive with that. So I am not out of the camp that thinks that the market can return to that 18-week average. I'm still very much in that camp. When I come to the S&P, I've got the same stochastic reading. I have the same lower highs, lower lows. Therefore, the trend of the swing line is down, but it is countered because you're, again, over that 18-week moving average. The two fight each other. I'd like to see this market get back to that 18-week average to find a home there. When we get to the NASDAQ, a complete different looking chart. This is what you call an embedded reading. It's when the slow stochastic, which is made up of two lines, get up and over 80 and they start going sideways. The traditionalists look at 80 and 20 as overbought and oversold on the slow stochastic. I have a different take on that. I consider 70s and 30s more important. And when they embed, which none of the others I'm aware of even look at that, I say the market is still innately very strong and pullbacks are being bought, and we're seeing that right on this chart. Should it decide to surge forward, upper Bollinger Band, if it goes for it's around 55.79. The Russell has nothing. It's got the higher high, the lower low, and notice how narrow you're getting on those Bollinger Bands. Momentum has also died off. So I view that market as very, very quiet. The daily chart of the VIX, you still have a nice pattern of higher lows all the way through here. Should you take out 1254, I think that would be a sign that the stock indices want to pull back. Pulling back from here and down, I can't get a new sell signal on this type of pattern. On the weekly notes, you've got a pattern of lower highs, lower lows. But the market keeps fighting to stay over that 18-week moving average 2 weeks in a row now. So it is stopping you from being a short seller in that market, but it's also not throwing out yet any buy signals. To get a buy signal, you've got to take out the highs of last week, at which would be at 125.09. Unfortunately, you'd be buying almost right into the Bollinger Band. That doesn't make sense. In the dollar index, you have a pattern of a higher high, a lower low. It got its footing at the lower Bollinger Band on the weekly chart, and it would not surprise me to get a challenge of 101.14 on the next surge to the upside. This market is very much in sideways action, and you can see that on the Bollinger Bands as well. The euro currency made its run to the upper Bollinger Band, and the flip-flop of the dollar got thrown right back. Now, it does have a pattern, though, of higher lows and higher highs. So the support numbers around 106.47. You'd have to take out 104.90 to scare the bulls off very much, but you are in a market that has lost its upside momentum. As you can see there, it's starting to point down. In the British pound, we got this week to 126.43, which took out the high of 125.74. So we have a lower low, a higher high in very much sideways action. It's what I call a churning market, not really trending. Then the Canadian dollar. It's been a hard market to be short. The longer-term charts have been short. I think you can see that. Lower highs, lower lows under the 18-day average. If you take out last week's high of 75.48.5, which you have not yet done, it's 15 points away, that could give you the buy signal that carries the market possibly up to the 100-day average of 76.04. In the Japanese yen, the pattern has been one of a lower low, a higher high, right into the upper Bollinger Band. I keep saying that in market after market, and you're finally getting your correction. Crude oil found its legs against the lower Bollinger Band. You're getting a bounce in the market. It doesn't have a charting pattern either. It's got a higher high and lower low. I look for resistance around 52.11. And tell me where you see the resistance in the nat gas. Pretty clear here at 321.60. And the market still has that overall pattern of lower highs, lower lows on the weekly chart. So this should be formidable resistance on that market. I want to remind you about Modern Trader magazine. You get a free subscription through us to it. Now, if you go online, you are going to buy it from them. Their normal price is $79. I believe you can get it also mailed to you as a hard copy, but that's even more money. What we're talking about is getting it emailed. It's got its own built-in reader. It's just so easy to read. It's got great articles. It doesn't matter if you're a stock trader, an ETF trader, derivatives, FX, article upon article in here. I can't wait for it to come each month because I sit there and read it like a madman. And as I said, great articles. Now, soon we're going to have the May issue. Remember, it's a magazine, so they do these ahead of time. But you can see outlots, KOL, RL, the options, FX, dollar, commitment of trader reports, the ETFs, story upon story. And look at these graphics. When they write articles, they're just not written. I mean, they really take you through. They help you to understand, and no, you don't have to be a math genius in order to keep up with this like some other publications. How do you get a free copy, including Market Focus that comes to you daily? Call us. Go to our website. You'll see a carousel of free offers. Click right up here if you would like. And on that, what you can do, of course, is from right there, when you click it, the form will appear. Fill out that and anything else you want, we'll get it to you. In the meantime, you have a great weekend. I'm Ira Epstein, and I'll see you on Monday.